Hello everyone, I am Navin Gadidala. I work for Oracle in the product development and product management team. I'm a senior principal product manager for Oracle, and I'm responsible for all the leasing modules, be it Oracle Property Manager or Oracle Leasing Finance Management or Oracle Equipment Lessee Accounting. These are some of the modules which Oracle handles all its leasing requirements for the customers. I did almost like a similar video sometime back. This video just takes it forward from where it left last time. And we have completed the solution for IFRS16 changes as well as the FAS changes. And in this particular video, I will be discussing the end-to-end solution that Oracle has come up with. Let's quickly go through some of the requirements as well as timelines and what Oracle has its kitty for this solution. So the standard for IFRS16 and ASC 842 came out sometime in January 2016 or February 2016. Everybody was busy interpreting the standard, and then people had to assess what is the impact of the standard on their business, and then people had to implement the standard, and finally we have to account as per what is provided in the standard. Moving on. Needless to say, the standard had the maximum changes on the tenants of the lessee accounting. The lessors almost like went scot-free. Not many changes for the lessor accounting. Most of the changes are on the lessee side. I'll be discussing very quickly, high level, what are these changes and how Oracle is providing its solution through its Oracle Property Manager as well as the new equipment lessee accounting module. And as far as the difference goes between these two standards, while IFRS follows a single approach, single model for all operating as well as finance leases, as far as the tenant accounting is concerned, for US GAAP, the distinction still lies to some extent between operating leases and finance leases. While operating leases are going to be accounted slightly different in US GAAP from IFRS, the direct finance, the finance leases are going to be accounted almost similarly between US GAAP and IFRS. These are some of the important days that we are talking about. People have to be compliant with the new standards for the period starting after 2018 December or January 2019. And what is very important to note, there is a 2-year look back period. So people who are following US GAAP, they will have to maintain data as far as 2 years back. They have to go back and maintain data for 2 years. That is what we call it as 2 years look back period. For people who are following IFRS, the look back period is going to be just 1 year. So what do I mean by look back period? So the standard says you will have to prepare comparative balance sheets and income and loss statement for 2 years for US GAAP, and for IFRS you'll have to maintain as if the accounting standard was in effective from 2018. So in order to provide the comparative statements, you should be having a solution which should be capable of generating these balances for you so that you can add them as comparative balance sheet or comparative income and expense statement. These are very, very high level. When I get into the application, you'll be able to appreciate what is our changes, how are we dealing with these changes. So as part of preparation for the customers, they'll have to understand their contract, harness their contracts, they'll have to revise their policies, how they're maintaining these contracts today. They'll have to modify some of their systems in order to produce these balances. They will have to review all these impacts and update some of their processes. And finally, all the disclosures which are required by these standards will only come out of the system if you have implemented some good solution like Oracle solution. And once all of this is done, you are ready to meet the deadline for 2019. The standard will be adopted from 2019 for you. Okay. What are these changes? This one slide is like very, very dear to me. I love this slide. In one slide, almost all the changes are being captured. So what are we seeing here? Before the accounting changes, there was nothing specifically mandated for assets or liabilities to be created from tenant's perspective in the balance sheets. But after the accounting standard will be implemented, the tenants are going to be responsible and liable to create and maintain these balances, something called as right of use for the asset and lease liability. The tenant, though they do not own the asset, they do possess a right of use. So this particular right of use has to be calculated, brought onto the balance sheet, and it's just not one-time activity. This is something you will have to maintain these balances throughout the lease life. So if the lease life is say 5 years, 60 months, you will not only capitalize the right of use and lease liability, but every year you will be tracking these balances to zero by the end of the lease. In the income statement, the same lease expense is going to be broken down into amortization of ROU and the interest calculation on lease liability. So the same expense is now going to be split and shown as two expenses. In IFRS, there is going to be two different lines. There is going to be front loading of expenses. For US GAAP, however, it still says the lease expense, the single expense, which is the average of all your payments, have to be average, and that average is what is going to be called as lease expense. And the split is not so important for US GAAP, but however, the way you arrive at this amount is going to be very important. So what it is doing, what is the impact it is doing to your balance sheet? Your lease assets are going to be shown at a higher amount. They are going to go up. Similarly, your financial liabilities are also going to go up, because what was earlier not required to be brought onto the balance sheets is now being asked to be brought onto the balance sheets. The difference between your leasing assets and the financial liabilities for a tenant will be shown as a deduction from your equity, if at all there is any difference. Coming to the income statement, your operating expenses are going to go down, because there is a split between your amortization of ROU and the finance charge here. So that is why what was earlier shown as a single line is now being split into two lines, and the two lines go under different heads in your income statement. Hence, your operating expenses are going to go down. Your finance costs, however, are going to go up. Earlier, there was no charge for finance cost in the form of interest. Going forward, there is going to be finance charge. There is also some impact on your cash flow. Your operating cash flows are going to go down. Your financing cash flows are going to go up. So when I say going up, though there is no change in your out-of-pocket expenses, what is, however, going to change is the way you represent these expenses in your income and expenditure statement. And net to net, that is why I'm showing it here. Net to net, your cash flows are going to remain the same. It's only the representation of these cash flows will be going into different heads at different point in time. That's why there is some change within these two cash items. Moving on. In this particular single slide, at a high level, the whole scenario is going to be caught, something like this. Let's say your lease is starting on 1st of January 2019. The duration is for 48 months. Your payment is 8016. Let's say this is the rental payment, a lease component payment. At the same time, you also have a service payment here. For the purpose of the accounting standard is very clear as to what is leasing component, what is not leasing component. So let's say this 1344, which is a mere service item where there is no leasing component, we'll call this as non-leasing component. So this amount will not be considered for capitalization of expenses and capitalization of liabilities. However, it can be expensed off in the same year when it is paid. So when these two amounts are added, what you get a total expense for that period as 8016. Let's see how is this being represented on your balance sheet as well as the income and expenditure statement. The PV of rent has been calculated from the rent using a discount rate of 5%. Now the discount rate of 5% represents your cost of funds. So this is a very important concept. We have a whole setup for that, where you can set up all your discount rates for different points in time. So based on that, the relevant discount rate is going to be picked up and your present values are going to be calculated. So before the accounting standard came into picture, this is how it was going to look like. In your balance sheet, nothing was being capitalized in ROU or liability. And coming to the expenses part, the entire amount of 8016 was being straight away deducted as an expenditure. But after post accounting changes, you're going to be creating a right of use, as I said earlier, for 24,798 and a liability for an equal amount. Many a times your liability and ROU may not be the same. There could be some components which are eligible for ROU but which are not eligible for lease liability, because there is no liability that is getting created. Maybe you paid it upfront, but you want to capitalize that. So there could be so many items which qualify for lease liability, which do not qualify for ROU, or vice versa. So in this example, we started with a payment, or we started with a capitalized amount of asset for 24,798. With the amortization, every year, this amount keeps coming down until it becomes zero by the end of the lease. For the liability, again, it starts with 24,798. You add the interest expenditure every year and you deduct the payment from this liability. Hence, the liability also, through a process of amortization, similar to what we have in ROU, the amortization will bring down the liability down to zero. You add the interest, you deduct the payment, and finally, your liability and ROU are both going to come down to zero by the time the agreement is going to come to an end. By the time the agreement is going to come to an end, you do not have any liability to show in your books, nor there is any right of use for that asset. For that reason, these amounts are going to come down to zero. However, the changes in your net income statement is going to be something like this. The operating expense for service, which is not a leasing component, as I explained earlier, for 1344, is going to be expensed off every year as and when it is incurred. The lease expense for 6672 is, however, broken down into depreciation, I would say amortization, since this is a financial asset, and there is going to be a split between depreciation and interest expense in this way. So the totals may not match for IFRS because there is front loading, but by the time you come to the end of the lease, your total depreciation expense and interest expense will total the leasing component expense for all the 4 years, or rather 5 years. In the case of US GAAP, that's the primary differentiation point between US GAAP and IFRS. The same lease expense for 6672, which you're paying every year, is going to be split between your interest and amortization. For IFRS, however, there is a front loading of expenditure. Initially, your expenses are going to be a little higher, but as time passes, as you come closer to end of the lease, your expenses are going to go down. And finally, the total expenditure, the 6672 multiplied by 5, is going to be split between your depreciation and interest expenditure. And this process has been established as part of phase 1 of our project. And we use that same process of calculation of this interest, amortization, and ROU and lease liability, the present values, all is part of our phase 1, where we built all this infrastructure for you. If this example is understood, let's move on to quickly touch base. What are the solution components in order to achieve not only these balances, but also do all the accounting out of the system based on these balances? As I mentioned, I'm responsible for all leasing products within Oracle. So what are the leasing products that Oracle has? Oracle has Oracle Property Manager to manage all your real estate portfolio, both from tenant as well as landlord's perspective. You can also set up some subleases. So Oracle Property Manager maintains the tenant perspective as well as the landlord perspective. May not be for the same lease, but you can account for those leases either as a tenant or as a landlord. Then there is a new enhancement to Oracle Property Manager. We call it as equipment functionality. So Oracle Property Manager needs license from Oracle to use Oracle Property Manager, whereas the equipment functionality, which is being added subsequently to meet the IFRS16 requirements and FASB requirements, doesn't need any separate licensing. The financial licensing will give you a license to use the new module that is being built. Oracle Property Manager, it has the two phases of the solution have already been released, both on 12.13 as well as 12.2. Equipment functionality is going to be released sometime middle of July 2018, and for the 12.13, the solution is going to come out sometime in September 2018. Then there is also another module called Oracle Leasing Finance Management. This is primarily for handling equipment, but from only lessor's perspective. This doesn't handle the tenant accounting or the lessee accounting, but these two modules will handle all your tenants and lessee accounting. Moving on. So this one slide again kind of captures all the solution components. So in order to calculate all these balances and to report them onto reports, we spent the phase one time and we built all the infrastructure and those reports, which will help you to report during the look back period or create the data which is needed to be reported during look back period. So we created an infrastructure where you can hold the interest rate index. We call this as cost of funds. And then on the leases, we have something called as a lease classification, and you will have to define your lease as operating, or you will have to define your lease as finance lease, and then you'll have to select your interest index. And then if it is going to be equipment, you will also capture some more details on the asset, which is missing in the case of Oracle Property Manager. You don't need so many details to track your asset, but this functionality has been enhanced for equipment lessee accounting module, where you will also capture some more items like serial numbers, which item of your inventory is being used to create the asset for you. When I say asset, it's not the physical asset, it is the right of use. So that right of use is being actually stored and captured in Oracle Property Manager, and there is no integration with fixed assets. That is something very important to note. We do not have any integration with fixed assets because this is just a financial asset. This gives its birth in Oracle Property Manager, and also it dies the natural way in Oracle Property Manager. But if the users want to track items like who is the employee who is responsible for the asset, what is the cost center, serial number, which item instance it is being used, all this are being enhanced in equipment lessee accounting module so that these details are available with you. Coming to the payment terms, on the payment terms, we made enhancements by providing some checkboxes. Using that, your balances are calculated. I'll talk more about this as we reach some of these slides or screenshots. And we did a lot of investment on the options. Options form very important part of the overall solution. As far as the accounting standards are concerned, any option which is very, very likely to be exercised will have to be factored into all your calculations. So for that reason, we provided infrastructure where you can capture options like renewal option, termination option, purchase option, residual option. So not only these options will be created and factored into your calculations, throughout the life cycle of the lease, these options are going to be tracked. There could be some changes to the options, or the options could be exercised, or the options could also be terminated. So we handle all these changes as part of the out-of-box solution. So this is all as part of the phase 1 solution plus the reporting. Coming into phase 2, from the balances and streams which are created during phase 1, we started or we enabled accounting. When I say accounting, so as and when you plan to move to this solution of Oracle, we call that as a transition process. So you will have to provide a transition date, and from there on, the system will start generating accounting for you for these balances and stream. So RU, liability, amortization expense, interest expense, etc., etc. All these are going to be accounted for you based on the configuration that you set in subledger accounting module. So this box in red in color, is what has been enabled in phase 2, as part of phase 2. So till reporting, this was all part of phase 1. We provided the infrastructure, we provided way to do all the calculations, we provided a way to report these calculations to the end users. So all this was part of the phase 1. The red box is part of phase 2, where we are actually enabling the accounting for it. Moving on. I'll quickly touch base on some of these screens which you're already familiar with, but this will give a good background for you to understand phase 2 solution. So we created something called a discount rate index, where you can have multiple discount rate index for the same operating unit. If you have class of assets, something like, let's say, your assets have life of 20 years or 15 years, and you want a particular discount rate index to be applicable to this class of assets. So you may end up creating multiple discount rate index. It's up to your company policy, and that is where we support multiple discount rate index. There is an effective start date. This is the date when the discount rate index starts, and within each of the discount rates, you have a series of dates plus some discount rates defined which you can add, and based on these discount rates, these fly to the lease. When you associate this discount rate index, you have a name here. This name, when you associate on the lease, the discount rate gets picked up from this discount rate index, and based on when the lease is created, let's say your lease is created in January 2017, so this discount rate is added to the lease. So for the January month, whatever discount rate index is existing in the discount rate index, that rate is picked, and all your calculations are based on that discount rate index. This is how a discount rate index looks like. For a series of dates, you have different discount rates. There's a name associated to this. This name has to be associated on the lease. So based on your period of time, let's say you're in June 2018, this particular discount rate index will be picked up and the values will be calculated. Once the lease is calculated with a particular discount rate index, the discount rate index generally doesn't change unless there is a need for you to recalculate. And also within the recalculation, for example, if you're doing something like renewal, then that calls for latest discount rate to be used on an ongoing basis. But for other type of amendments, something like you are adding a payment term, you are adding one more payment term to the existing lease, that doesn't really call for using a new discount rate. Rather, it would still use the existing discount rate with which it was created, and that will continue. On the lease, you will have to manually tell the system whether this is going to be operating lease or it is going to be a finance lease. There's a discount rate index. You associate the discount rate index on the lease, and then you add an adder rate just in order to spice it up let's say you get a discount rate of 5%, but you want to use on this lease, say 6%, then you can have an added rate of 1%. This is how it works. Then there are a series of checkboxes. So based on your exercise, the ROU asset or liability, the relevant checkbox comes into picture. The calculations are made based on that. You also have something to say like report from inception. When you check this box, so what are we telling the system is, you are making all your calculations from the lease commencement date. All of this I have very thoroughly discussed in the other video. You may want to go back and look at my other video on phase 1. That is where I elaborately explained all these checkboxes and how they work. And we added the checkboxes on term templates also. What this does, so when you select a term template, all these attributes are automatically defaulted onto your payment term. Similarly, this is the enhancement that we did to the options. Now you can define multiple options, and you can also manipulate how you want them to be in your scenarios. And the schedules and items which was showing mere cash flows has now been enhanced to show the impact of adding options as well. And these are the 3 reports that I was talking about, which was added as part of phase 1 of the solution: portfolio summary, portfolio detail, and lease detail report. This detail report is very detailed. It tells you how these balances have been calculated with very detailed amortization schedules as well. While portfolio detail and portfolio summary are more at operating unit level, where you get a total picture of your portfolio. What are the ROU asset value, what are your lease liabilities, etc., etc. With this, I conclude a quick update of phase 1 solution. I'll take just a minute break here. Hi, welcome back. With a good understanding of the phase 1 solution of Oracle, let us now try to understand how did we integrate the whole process of expenses, lease, when I say preparations, or finance lease, and also doing some, you'll also have to create your data. So you would be already having some information, some contracts, and all contracts. So once you create the contract, you should be able to create your data or update your data. So these APIs will also work for leases which are already finalized, which are lying in your system. So apart from creating a discount rate index and also putting in these checkboxes which are needed for doing all the calculations, then your contracts are ready to go for phase 2 solution. So you would create your contracts, and through that you will approve your payment terms, and from account rents go through and to add new audit, or there could be some change in discount rate index, or you keep processing the lease till it period end. The accrual process is a new process. So the same transfer GL lines to the accrual accounting, and this we want you to do. So how are we deriving accounting? Accounting is going to be derived based on accounting events, such as contract booking. When you do process and period end process, which are used for accounting. So whenever a contract is activated, we generate the streams for ROU, liability, interest expense, amortization, etc., etc., all for life of the contract. Once these are generated, there is a change in the ongoing basis. So at any point in time, the contract would have all the information which is needed for accounting, and which is stored in the form of sources. And these sources, accounting amounts and dates, is what is actually passed to subledger accounting engine. And the subledger accounting engine is a module in Oracle Financials which will help you to trigger and generate accounting the way you want it. So there are a set of account derivation rules which can be written in subledger accounting. We are not providing any accounting infrastructure for you because we want the accounting to be very, very flexible. So you should be able to configure your account codes. I show that. So what are we giving you out of box? we will be providing you three different representations. One we call it as IFRS, US GAAP, and your existing normalization accounting can also continue. All this can continue simultaneously at the same time. So how do you avoid these transactions getting mixed up? So if you set up, we will divert that to one primary ledger. If you into your use, and in one of the secondary ledgers is where I'll be generating my compliance accounting, US GAAP accounting, then divert this normalization accounting into one of the secondary ledgers. What this does for you, it will give you a set of accounting entries for easy comparison, for seeing what are the changes, for all the any kind of future reconciliations. This information is going to be very vital for you. So how the users can use the whole solution? Either they can choose not to take phase 1, not to take phase 2, just continue with whatever they were doing earlier. The normalization accounting will continue for them. Or user can choose to only enable phase 1 and set up the discount rate index and checkboxes, etc. on the leases. What this will do for them, they can use property manager or the new equipment lessee accounting module as a calculator. It does all the calculations for you. All the balances will be calculated for you. Once that is done, when you run your calculation program, all these balances are calculated for you. And through a set of these reports, which I discussed in my first presentation, you should be able to generate all your look back period reporting, and also on an ongoing basis, these reports will keep working for you. You will get a feel of your ROU balances, liability, everything will remain as it is for you. Or you can choose to, which is more preferred and right way of using this solution, you will enable the phase 2 solution. So the phase 2 solution will at the same time generate these balances, create the reports that you need for all this look back, and also on an ongoing basis. Plus the system will start generating accounting out of box from the system using the subledger accounting as a solution. Moving on. This is Oracle's suggested accounting. You a minute telling you on the for the transition date, this booking event, the lease liability should get credited, and the accounting for this remains same across IFRS or US GAAP. Different representation, no capitalization. And whenever whatever any kind of changes on the lease, your again standard ROU lease liability up, or if the amounts are going down, we show them as negative amounts. So the SLA account, whenever there is a negative amount, so 1,000. So we create an accounting event for minus 1,000, where your ROU and lease liability will be debited. And you can configure a transaction event. When you activate a contract, your ROU and lease liability may not be equal to each other. This will happen particularly when you bring a contract from inception. Let's say your contract is 10 years old, and today you are bringing your contract into books, you're creating accounting balances, and you're accounting for that. In that case, the ROU would have started 10 years back, your liability also started 10 years back, but the way they are amortized differently. That is why today's value for these ROU and liability will be different. I bring in or a reserve line between. Moving on. Okay. So what happens? What is the accounting that takes place when you do a non-lease payment? When you do a non-lease payment, that means the liability is not checked on it. In that case, based on whether it is a normalized expenditure or non-normalized, you can achieve this accounting. You can still debit your normalized expenditure and credit your liability. Yes, you may want to immediately expense it off. That is also possible under both IFRS and US GAAP. But if the liability is checked, then you may want to debit your lease liability and you will create your AP liability. We support this. How do we do this? So when the AP invoice material goes from the property manager to accounts payable, in one of the flex fields on the line, AP line, flex field number 2, we populate a flag called liability yes or no. So for these invoices, the liability will be checked as yes. So using the AP line level flexibility number 2, you should be able to derive the debit entry to lease liability. I'll be showing that in a minute. And talking of the period end accounting, you will be needed to generate your interest accrual and amortization expense. How do you do that? The same process which used to generate your normalized expenditure earlier, transfer normalized lines to GL. That process has been enhanced. You can run this process month end. When you do that, your payment terms should have been already approved. If that is already approved, so what the system will generate? It will generate the interest expenditure. You should be able to debit your interest expenditure and then credit your lease liability. So the normalization accounting will happen as it is, but the new accounting will not take place. For IFRS and US GAAP, so for IFRS, so we have provided you straight line amortization. However, for US GAAP, the amortization expense is the difference between your lease expense and so at a very high level, this is the accounting and the accounting components. I think some of my slides have been interchanged, but I'll do just back and forth. So as I explained, when you book a lease, when you activate a lease or you do transition activity for your leases, the booking event is triggered, your amortization, your ROU and liability gets created, they get accounted properly. And these ROU and liability also consider your options, your one-time amounts, negative amounts, future amounts, variable amounts, rent increase amounts. This is all based on your configuration. If you want variable and rent increase to be included in the calculation, then you can achieve that from payment term templates. I'll be showing that in a minute. So if you want those to be included, then you will have to check your liability and ROU. And it's not necessary that for every payment term, you check both your liability and ROU. Based on your requirement, something can only be eligible for liability calculation, something can be only eligible for ROU calculation. It can be achieved that way using the checkboxes. So we put the onus on you based on your company policy, based on the type of an expenditure. You take a call what needs to be included into ROU and liability, or both or none. And if there is an addition of payment term, your ROU and lease liability gets added. These streams are going to be recalculated, and your amortization and interest expenses are going to be recalculated for all the future years. And if there is a renewal, similarly, we calculate the delta amounts. There could be additional payment terms, or with the same payment terms, you could be only extending your lease, in which case your future amortization amounts get changed. So we take care of that. We trigger an event called revision. So the revision for all these changes in the leases, we capture these delta amounts, and you should be able to always put your stream amounts and your accounted balances in sync. Similarly, there can be termination or contraction of a payment term. When that is the case, your ROU and liability may needs to be written down. We calculate that, and sometimes there can also be a gain or loss. So if you lose more liability in terms of carrying value than your ROU, then that gives a gain situation. At the same time, if you lose more ROU than your liability, then that is a loss for you. So your payment term can be end dated into the future. The payment term can be end dated for the system date, or the payment term could be end dated in a past dated. So we call this as future dated termination, system dated termination, and past dated termination. So based on the type of termination, we calculate these delta amounts. We bring down your ROU and liability based on the checkboxes, and we also recalculate your remaining amortization and interest accrual, so that your stream balances, your accounting balances are all in sync at any point in time. You can use these reports to do a reconciliation between your accounting balances and the stream balances. There can also be some other kind of amendments, like there can be a change of interest index. You may want to change your interest index. You may reclassify a lease from operating to direct finance, or vice versa. So for all these type of changes on the lease, your amounts for ROU liability change, and your future amortization and interest accruals change. So we do all this for you, and you can use some negative terms. Since there is no direct solution for impairment, you can use negative terms, and through uh, the amendment commencement date, you can manipulate when you want this negative term to be factored into, either from a future date or from a past date or from a system date. And similarly, once you add your options or you forgot to add your options, you can always add the options at a later point in time through a revision. So everything, the Oracle suggested method is to do a proper amendment rather than edit. So once you do an amendment, there would be a very good history of the same, and we also capture the accounting event and we do the accounting for you. And if your payment terms are in a currency different than your ledger currency, the functional currency, we call all those leases as forex leases, foreign exchange leases, and we capture the forex transaction event in the entered currency. We also convert that into accounted currency for you. We have our own set of rules. You'll find more information when you go through the release note on the subject. And not only this, we also enhance the reports so that the amounts which are entered in entered currency will be shown in entered currency. So the same report, for example, a portfolio detail report, can have some leases in entered currency and some leases in functional currency. So based on the currency that you use for your payment terms, these amounts are calculated in that particular currency. This also gives a lot of other complexities. This gives rise to other complexities. And using the balances which are generated from property manager and pushed to general ledger, you may also want to revalue every period end. So there is also a requirement as per US GAAP where your month-end liabilities needs to be revaluated. So you could do the revaluation feature in general ledger directly once we send all the balances to general ledger. So using the revalued ledger balance in general ledger, you should be able to post the differences to a proper account, and you will still be able to meet the forex requirement of the standard. And period end accruals. So when you run the process, the transfer normalized lines to GL, it also does the accrual transactions for you. So using suitable configurations, you should be able to set it up. Okay, I think let me run a little bit. So how do you trigger phase 2 solution? Now I'll be spending most of my time in the application. So the same system options screen has now been enhanced. So how to go to the system options screen? From the home system options, you should be able to see it in the setup. On the system options, so for example, I update the system options for vision operations. We added a new section called compliance setups. So this is where you will have to provide a transition date. A transition date plays a very, very vital role. Until you provide the transition date and then you finalize this, there is a process for finalizing it. Unless you do the finalization, your phase 2 solution is not active for you. So till that time, the property manager on the equipment leasing will work only as a calculator for you. So once you key in the transition date and run the calculation streams for ROU and liability, that program, followed by another program, your transition date is frozen. So for example, what am I telling system here? I want to transition as of 4th June 2018. If I want to transition as of 4th June 2018, I must have run the calculation program till 31st May 2018. So once those program is run, all your balances are frozen for 31st May 2018. And from 31st May 2018 till 4th of June, for you to roll your balances forward to 4th of June, then you will have to run another transition calculation program. Once that program is also run, then this date is frozen. You cannot change this date. And how do you provide this date? This date can only be a date in the current month, and this date cannot be into the future. And after this date, there should not be any transactions in the system. So if there are any transactions, then you will not be able to save this date. There should not be any transactions after this, and this date cannot be into the future, and this date cannot be in the prior month. So once you follow these three rules and provide the date and run those processes, you will find more information about this process in the release note as again. And then once you do this, your date is frozen. On the date of this, the 4th of June 2018, a booking event is triggered for all the leases that you have in your system. So all the carrying balances of ROU liability are brought into property manager. Account balances are created. You should be able to account it through subledger accounting. When you run the create accounting program, the accounting is done, and these balances can be transferred to general ledger, and these balances will be tracked, created in property manager, and they will also die only in property manager. There is no integration with fixed assets. Let me reiterate. So these are financial balances we create and we kill them in property manager. And any point in time, you should be able to run the reports to see what these balances, the stream balances look like. There could be differences between your stream balances and accounted balances. If your accounting cycle is not in sync with your stream balances. So these are some of the tools that we provide so that you can do your reconciliations. So the next important input that the user will provide is the GAAP regime. So when you provide the GAAP regime, you have options for both either IFRS16 or ASC 842. So if you think your primary regime is going to be IFRS16, choose IFRS16. If you think your primary regime is going to be ASC 842, then choose that. But if you think your GAAP regime requires you to both account for IFRS in one ledger and US GAAP for the same amount in another ledger, secondary ledger, then you will have to choose something called as both. Once you do that, you will have to tell the system which is going to be your primary regime. It can be either IFRS or ASC 842. So the primary ledger will take these balances and it will create accounting and it will create numbers as per IFRS 16. But if you choose ASC 842, it will do as per ASC 842. And there is also another very important setup. We call it as calculation frequency. If you choose the calculation frequency as daily, then your interest expense, your amortization expense is calculated on a daily basis. Why do we need that? So some of the customers may have some irregular calendars like 445 or 5444 or whatever. So their monthly days may not equal the English calendar months. In such a case, it is advisable that you use something like daily. But if your calendars are periodical, the normal property manager calendar types, then you are advised to use periodical. So with this, the compliance part is done. You provide these values, you set it up, and then you run those processes. That will freeze the date and you are good to go. Let me do one thing. Let me quickly, before we run the accounting process, the setups and all of it, I want to pick up one lease, and I want to pick up the lease from equipment lease. In my first demo, since I spoke at length on the property manager screens, I want to focus in this particular demo more on equipment lease screens here. So for example, we built all the screens new. So this will help you to enter equipments in your leases. So this is a totally new module which is coming free with financials. The property manager of course needs property manager license, but these equipment leasing, the new screen that you're seeing, these are used to capture all the information, contract information for you to enter equipment leases. So let me query one lease. something like this one. So this is your search screen. You perform search for your leases, then your results are fetched this way. And let's say I want to see this. This is already finalized, but I want to take a quick tour of this lease. So you provide the operating unit, lease name. I'm very purposely using the equipment leasing screens because these are new. So the underlying functionality is the same for equipment leasing as well as property manager. You enter all the contract details and then you finalize the lease. Once you finalize the lease, the next step that you will be performing is the calculations. Before transition, you'll have to run for phase one solution. When I say before transition, you'll have to run the calculation program explicitly. But after you move to phase two solution or the transition is performed, you don't have to run the calculation program. Every time you finalize your leases, that is when all your balances are calculated for the life of the lease. One thing very important to note, for property manager, there is an explicit process to finalize the transition date. So your accounting will get triggered only after the transition. For equipment leases, we don't have such an explicit process. We kept it very simple. The day you load all your leases into equipment lessee, you perform the checkboxes, everything through the API, the leases are good to go. That is when the accounting gets triggered, the transition account gets triggered, and any lease that is created after that will by default be accounted with the booking event. I'll show you that in a minute. So this particular lease is for 4 years, and this is how you can see the information. The commencement date is 4th of December 2015, and it goes all the way till 3rd December 2019. And we have a car lease term template. Since this is an equipment, I created a template for car leases. What I'm telling here, I'm telling it is an operating lease. I have a discount rate index which is associated here. I can spice it up with an adder rate. And by default, okay, before I go to the parties, you can add more information through the notes, additional comments. And we also have one DFF here. So you can add more fields as per your requirement. So by default, two parties are created here, a lessee, which is you, and a lessor based on the party which is created in the general tab. So these are by default added here. And you can add as many assets as you want. And we have a very good API in place. So all that before you book the contract. So through the API, you can load multiple assets, and the assets have a lot of information, and the assets are created through the item which is already set up in inventory. So you pick up the item and create an asset. So you also provide a lot of description, and then you can also provide serial numbers. You can provide where is the installed at location by choosing the location. You can provide an amount for these assets, the effective from date, effective to date. All that information will be residing here. When this is done, you may want to add payments for those assets. So I have about 3 payments here, as you can see. So the processing fee I added through a revision. Earlier on the lease, there was only insurance and base rent. So on the base rent, all the checkboxes have all been checked. The payment term is ready. I associated the base rent to the asset which I created in the system. And the insurance, however, is not associated with any asset. It is at a contract level. And what is so interesting to note, the insurance is not participating in calculations. How did I achieve that? I did not check the checkboxes for ROU and liability. But for the base rent, I did check the ROU and liability. So the base rent is a leasing component. The insurance is a non-leasing component. At the same time, you can also be adding options. And another point to be noted, the currency that I selected is euro. while my contract is in USD. My functional currency is USD. So this is a cross currency lease or forex lease as I call it. And using these amounts, your balances are created. So once this is done, okay, you can add options. If you add options and you check the checkboxes, then your options will also be considered into calculations. Okay. So once you do that, and once you activate the list, you don't have to perform any calculations or anything. Automatically, the leases get triggered. Okay, for example, let me see if I can get a lease which is in draft status or something. I quickly show you how to trigger the process. So for example, I pick up this lease. I entered all the information. So one thing which I couldn't show in detail earlier was the assets tab. So since this lease is not finalized, let me go around the asset. This is where you enter your serial numbers. This is where you pick up your item from item master. You provide some amount for that. You provide a start date and end date for the asset. You pick up and install that address for the asset so that you can track this particular asset. Okay, let me quickly move on. So once the payment and everything is done, so finally, once you're convinced the lease is good to go, just like in property manager, you will have to flip this to final. So once you flip it to final, your background process is triggered. Let's see if this gets okay. So there is an error here. So if this error is corrected, it is associated with the payment, then you are good to go. So once you do the final, your schedules and items, just like in property manager, gets triggered. So for the previous lease, I have the schedules and items ready with me. Yes, this is what it looks like with all its payments. Okay. And let me quickly pull the report also. I think that is going to be very good. So using the report, you should be able to make a comparison. Okay. I thought I had the report ready with me. But let me quickly go there, open the report. More or less the functionality between property manager and equipment leasing is the same. I keep repeating this. So the property manager is available with the new functionality for phase 2, phase 1, both on 12.13 and 12.2, while equipment leasing is going to be available sometime in July, mid of July 2018, and on 12.13 it is going to be available from September. But the functionality is not different, so you need not worry. You can start looking at property manager for now, get used to all these processes, and once the equipment leasing module is ready, it should be an easier uptake for you. Okay, so the original report, remember I performed an amendment on this. I added a payment term, but the original report looks something like this. The same reports also continue in phase 2, and these reports are the basis for all your booking and revisions and etc. So the base information is not changing. Okay, let me pull this one. So what are we saying here? When we look at the report, the report is very detailed with the calculations for ROU lease liability. So this is the original report before I ran the revision process. So I tell how I calculated the ROU, right of use, and liability, and its detailed amortization schedules. This is for the leasing component. There are two components, right? And the other component, which is non-leasing, so this is not participating in calculations, so it doesn't affect your ROU and liability balances. And why did I mark this row in yellow? So the lease is booked sometime in June. So we look at the balances of ROU and liability that exist on either the transition date or on the first of the current period. And if the lease is created, say system dated today, then we look at the balances as they exist on system date, and we create the ROU and liability for those balances. So in this case, we would have created booking transactions with these amounts. Okay. So for these amounts, the booking transactions have been created. They got created first of the current month balances. So where do you see as a user all these transactions? We created a new screen for you. You should be able to see all your transactions here at one place. So in the same property manager, click on under transactions, click on view transactions. So this is all we are looking at, booking transactions. Please make a note of it. Okay. Creation operations. And when I key in my lease, I key in using the lease name. Probably that needs to be changed to lease number. Whenever we get time, we'll look into that. So I select my operating unit, I select my ledger. Okay, let me reopen this page. Yeah. So my view transaction page comes up for selection. I'll provide my operating unit. I want vision operations to be my operating unit. And this is very important, your ledger name. So for the same vision operations, for the same lease, if you have both the regimes enabled, then accounting will be generated multiple ways, multiple representations as we call it. And this is stored in different ledgers. So I have two ledgers. So let's start with vision operations. I select my first ledger as vision operations, which is my primary ledger. I provide my lease name. And since this is a euro lease, which is in euro, I select my currency as euro. Your entered currency is euro. So you get to see all the transactions in property manager or equipment lessee accounting. If I change this ledger to the secondary ledger, the amounts are also going to change. Though they get calculated and stored as per FAS regime, those numbers could be slightly different from the IFRS numbers. Very good. So just take a look at this. So the 426 now gets changed to a different number. The booking number gets changed. So how are we generating this? Okay, for example, if you click on the transaction number, right? So for every payment term, I generate liability ROU calculated and displayed on the report. That becomes my basis for the report, and the difference is put into a reserve line. So these amounts are calculated for every payment term on the lease. And once they are calculated payment term wise, you can choose to post them in summary, or you can choose to post them in detail. So if you choose to post them and create accounting does it for you in summary, then all this gets summarized and you will find only one accounting transaction at lease level. But if you choose to post them in detail, so we gave you that flexibility. You can choose based on your requirement and your configuration whether to post in summary or in detail. Okay, and there are also other transactions for revision, accruals. So I will show actual accounting, but before that, I want to complete the other processes. So once you book the contract, this transaction for booking is auto-generated. If you perform any revision, the revision transaction is performed, as you can see. And month end, when you run the accrual process, the accrual transactions are generated for you. So this is what, at a high level, the cycle looks like for you. So for example, I had a slide which captured whole process. Okay. Right. So you can see the accrual transactions, booking transactions. So like in property manager, before you can generate your accruals, you will have to run the approval. So in property manager, there was a screen where you would go to the payment term, open the payment term and approve it manually. And then once the approval is done, the term gets approved and you can run the normalized, the transfer normalized lines to GL program on that. At the same time, the same program will also generate the accruals for interest accrual and amortization accrual. One thing to be noted here, the accrual transactions cannot be generated into future. So for example, now we are in the month of June. The accruals for June can only be generated either on 30th June or any time after 30th June. But you cannot run accruals beforehand for this month. The logic that we went with for the time being, if there is a change to the lease between today and the end date of the month, the accruals may need to be changed. So we didn't want to make it very complex by creating the adjustments and all of it. So we put a hard limit on the user to run accruals only after the month ended or on the last day of the month, so that there would be very, very less changes to the accrued amounts. So in property manager, the way you would approve the terms would be by running a process called approve your terms. So once your terms are approved, then you can run your transfer GL normalized lines program that will create the accruals for you. Okay, with that, the process in property manager is complete for the month end, and then you may want to run the create accounting. Based on your setups, the create accounting will complete the accounting for you. And once the terms are approved, you will run your export to AP process just like you do in property manager. Once the lines go to AP, the AP will generate the accounts payable invoice for you, so that your payments are accounted in accounts payable. And the accounts payable invoice is what is used to generate the lease liability deduction. The payment amount is debited to lease liability. Lease liability is a credit balance. So we do that by sending a flag, liability flag to AP. If the liability flag is not carried to AP, that means it has to be either expensed off, which is a non-normalized. If it is normalized, then your normalized expenditure gets generated from property manager when you run the program. In the meanwhile, your accrued liability gets picked up. It's all based on the flag that we send from property manager. So just quickly, I'll touch what all processes you'll have to run. And with that, we should be good to go for the accounting part. Okay, approve or cancel schedules. This is the program that needs to be run. In property manager, you can do it manually for lease by lease. But in equipment, you don't really have that luxury. There is no screen. The schedules have to be approved only through a process. Okay. For example, you will run this process. Approve or cancel. So everywhere, when the process is different for equipment leasing, you will find EQP written there, just to differentiate between your property manager and your equipment leases schedules. This program has to be run. And once this is done, you will do your export to AP, which will send the equipment payment items to AP. So this is the program which needs to be run. And once these lines reach AP, the standard AP open interface import program has to be run. And once that program is run, the AP invoice is ready for you in AP. You can open the invoice, validate the AP invoice, and then do the normal accounting. So based on your rules, the AP invoice gets accounted. So though I don't have time to show that, what I can show you is something which is already generated and ready with me. So the AP invoice, what I wanted to show quickly perhaps is what is very important to note here quickly. It's always race against time. When I am doing pause here. Okay. Hi again, I'm back. So my file is ready. Let me share the file. So there are two invoices from this contract which went to accounts payable. So one was 22196 and the other 22197. While the first one is the second one is a leasing component invoice. The first one is a non-lease component. Let's see. Let's take a look at this one. Okay. Make a note of this number here, 2225, which is normalized accrued liability account. When it comes to the other invoice, 400, so the debit, the item expense actually goes to 1952, which is the lease liability account. This is how it has been configured. So let's take a quick look at all the accounting configurations that I have done to achieve the accounting the way it runs now. I'll take another 5 minutes and the sections look in the okay. Need accounting section for you. Okay. Within Property Manager, I added subledger accounting menu. So you can also do the same. Let's look at the new subledger components which have been built here. Okay, I go to accounts, methods, and builders. So the way subledger accounting works, you have subledger accounting method, which is built with all the components, subledger components, and the SLAM, subledger accounting method, is actually assigned to the ledger. So if you want two SLAMs, one for IFRS and one for US accounting, you will have to build it up that way. And once it is built it up, you'll have to assign it to the different ledgers. So let me come from the SLAM part here. So if I want something like IFRS, okay, this is how I went about building my IFRS one. Okay, maybe not the right one. Okay. And the property manager, okay, this doesn't seem to be the right one. I'll query the IFRS SLAM, which will be added to the ledger. So this one, this is a user created. So how do you do that? You start by copying Oracle's SLAM. When you copy that, you get a user type, this one. So once you get the owner as user, this is ready for you to make all the changes. So this particular SLAM has only two application accounting definitions, one from payables, one from property manager, because that is all I will be doing if I am working as a user on property manager. So I made changes to accounts payable and I also made changes to property manager. So what are the changes that I made? So once the SLAM is created, you will have to assign the SLAM to the ledger. Let's look at the property manager application accounting definition quickly. So all these event classes have been added on the property manager application accounting definition, one for booking, one for lease expense, one for lease expense compliance, revision, termination, and yes, these 5 events have been added. And if you look at the lease expense, this was the normalized expense event, and the rule for this will not be enabled because we don't want this to be accounted. Since I want only IFRS to be accounted, so I have put some dummy accounting so that it doesn't really hit my accounts. We generally turn this off so that this accounting doesn't impact your IFRS accounting. The normalized lines are not really accounted. So the other transactions, however, like let's say for booking, when I open the booking event, I have 3 lines. I captured 3 lines. One will capture the liability, one will capture the right of use, the third will capture any difference between these two. So how is the liability getting picked up? This is getting picked up based on the conditions that you write on the lease liability. So I have used accounting class as PN booking. This is new rounding class. And when you take a look at the conditions, we added some new sources like regime code. You can use the regime code as IFRS. And we also added some new stream types as sources, something like liability. So these are hard-coded values. Only when you use rules like this, your lines will get evaluated. So once this line is built, similarly, I also built ROU. So the ROU condition will be again IFRS 16 and stream type will be ROU. And to each of these lines, I associate account derivation rule. Very similar to this, like this. So 1955 is my code combination. Either I can derive the entire flex field like this, or I can derive each of the segments differently from a single rule. So if I do that, I will have multiple rules here, but here I have a single account derivation rule which fetches all segments for me, and I'm calling this as right of use. So once you have built this, you can reuse this in revision also. You can reuse this in termination also. Wherever you are either debiting or crediting your ROU, you can always associate that with this. So on the line, again, what was very important to note, I was telling my event class is booking. This is how I create. And my accounting class is PM booking. And again, what I'm also telling, I'm telling the system to merge all my matching lines. Since you create multiple booking transactions for the same list, if there are multiple payment terms, and if you don't want all of them to be shown as separate lines, you can merge them. This is one way of summarizing your lines. So all right of use for that lease will be summarized and shown as a single line. All your lease liabilities will be summarized from different payment terms into a single line. So this setup is very, very important. And I have used it on one particular chart of accounts. You can choose your chart of accounts. And this is about the booking transaction. The next one, very important, is your lease expense compliance. This is the new event class which we provided, and you can associate a rule with that. So this is my primary ledger. So I call it as primary. And what do we need out of this? I need amortization expense to be debited. So I'm telling the system to pick up amortization as my stream type when the regime code is IFRS 16. For the other regime code, you will have to use ASC 842. And also I'm telling the system the event classes, lease expense compliance, my accrual and accounting classes are accrual. It's a debit line, expense is debited, and your ROU is credited. So the ROU charge is fetched through a separate line. The same amount, whatever amortization expense you debited, you will credit to your ROU, so that your ROU is coming down all the time. So it's a credit line. This is on the credit side. And your regime code is IFRS 16. Your stream type is amortization. Similarly, you will debit your interest expense and you credit your liability. I have a separate note for accounting configurations. This is attached to my release note. Please go through the accounting configuration document, and using this idea, you should be able to configure it. The other thing which I wanted to show, similarly, I have something for revision, I have something for terminations. So when you terminate, for example, till that point in time, you may want the system to generate the amortization, the interest expense. You will want the system to reverse your carrying balances on that date for ROU and liability. So you will need lines for that. And they can also be gain or loss. You will need lines for that. So I have created one application accounting definition for IFRS. Similarly, you will have to create one for FAS. Let me query that. So one for FAS, one for IFRS. And what is very, very interesting, remember I also told you that there is one existing application accounting definition which Oracle had provided even before the solution for accounting for all the normalized lines. So that still continues as is, but when we provided the seeded one or this solution, we added all the event classes, the new event classes, to this seeded one as well. This is just for your information. This doesn't really work for all these event classes because there is no accounting behind it. As you can see, the create accounting is not enabled for it. For the new lease compliance, the create accounting is not enabled for it. And if you want still to use this as it is, then you may want to either attach this to the primary ledger or you may want to attach it to a secondary ledger. And what is other thing very important to note, what works in this application accounting definition is the lease expense. The existing lease expense will work as is. You can put it to one of the secondary ledgers for all comparison purposes. And for the lease revenue also, it works as it is. Do not validate this, though it looks like invalid. Do not validate this because this is not complete. The validation will fail and you will not be able to use this after that. If you want to use this as it is. Even with its invalid, it will work for you. You attach it to one of the ledgers and your existing accounting will get diverted to that ledger. Because your event classes are valid, this application accounting definition still works for you. Let's quickly take a look at the change that was done in accounts payable. This will give you a very good idea how and what to do in accounts payable. So remember, if a payment invoice, a payable invoice reaches AP with the liability flag on, we want the lease liability to be debited in place of accrued liability or in place of the normal expenditure, the item expense. So how did we achieve that? You will have to write a rule for that. Go to subledger accounting, accounting setups, accounting methods and builder. Please look at my accounting configuration document, which is very detailed and captures these screenshots. Okay, let's say I have something like PM. So I copied the PM, the existing AID, and then renamed it as PM AP compliance. And I made the changes the way I wanted, only to one line on the invoice. So very important to note, the change was only made to one line on the invoice. So let me open the right one. Yeah, maybe this is the one. So on this one, on the invoices JLD, on the item expense, okay, this doesn't seem to be the right one for me. Yeah, on the invoices, in the item expense, this is the only change that I made. I'm fetching the code combination as is, and I'm overriding the account code through my own defined rule. So I'm telling the system to fetch 1952, which is same as lease liability, when the invoice source is Oracle Property Manager and invoice line flex field 2 carries a value of Y. This is very, very important. Please make a note of this one. When the invoice line flex field is 2 is equal to Y. Okay, I'll conclude this presentation with one more section, the last section. I will query through the view transaction screen and show you the accounting. For that, I'll have to switch my instance. I'm just switching the instance. I cannot show accounting in the existing equipment leasing module. This is still work in progress. I'll take you to one of the property manager instances where this solution is already available on 12.13 as well as 12.2. So how would the user go about it? You'll have to click on property manager revision operations, the property manager workbench. This is the last aspect in my presentation. So there is a new workbench which I created called view transactions. So the view transactions hold all the information for accounting from property manager. What I really wanted to show how these code combinations in accounting will appear to the user. So let's say I have something as HOU. And the HOU is on Hong Kong currency, HKD, Hong Kong dollar. And the ledger is also on Hong Kong dollar. So these are not cross currency transactions, but okay. And let me set the currency for this, HKD. And lease name, I'll do something like NAV. Navin is my name, so most of my leases carry my name. Let's say pick up a simple lease. Again, this particular operating unit is on daily calculations. So this is a backdated lease, so don't consider this as an error. This is a lease which has been brought into today, but all the amounts have already been amortized. So that is why you do not have any balances shown here. Let me query another lease, and I selected the IFRS ledger here. Yeah, there are some amounts here. So the way user looks at accounting is by selecting the transaction, clicking on view journal. Let me go back and try this again. Yeah, hi, I'm back again. So I'll query a transaction in one of the 12.13 instance. This is what this 12.13 instance looks like. I have NAV ROPS, whereas the currency is USD. When I query this, I said you have to click on view journal. This will show you what is the event class, event type, when was the event date for this event, booking event, and what's the status of the event. It is finally accounted, or it could be draft accounted, or no accounting. So these are the different possibilities. And if I want to view the accounting code combinations, the accounting lines, I'll have to select on the view journal entries. When I do that, I have so much information lying here. I'm telling from this, the regime code is IFRS, the ledger name is vision operations, it is finally accounted, and look at the code combinations. 1955 is my ROU, 1952 is my lease liability. And if the transaction entered currency is different, I would have the accounted amounts different. But in this case, the transaction is in USD, whereas the accounted currency is also USD. So you have the entire transaction in one single currency. And we generate this cross currency rates when we do the accounting for you. So if you click on any of these lines, this is going to throw up more information, like what is the AAD that I have been using and what is the journal entry name. You can add more description. Subledger accounting is very, very easily configurable. You can add more information as you need. You can add accounting sequence numbers here, which I have not done. And for the code combinations, you can add actually code names. So instead of seeing 1952, you may get something like LIAB, liability, lib. For ROU, you can directly use ROU if your values support that. So change your values to support alphanumeric or alphabets, then you should be able to see those in the lines. And I posted this in summary. I told you on the journal line type, there is that match lines option. So once you check that, all your matching lines will be consolidated into a single line. With this, finally, I end the presentation. Do let me know if you have more questions. My name is Naveen Gadidala. I work for Oracle. Naveen.gadidala@oracle.com. That's where you can send all your questions. And what are the resources that you have? You have one documentation which captures the accounting configurations. There is a release note. Plus, the release note also has all the frequently asked questions. After watching this presentation, I presume that you would not have any further questions, but just in case you do have questions, the FAQs document is a good source to clarify all your questions. Apart from this, these two documents, we'll also soon come up with the release note for the equipment lessee accounting module. Thank you. Thanks for watching this video. Thank you so much. Till more updates, it's bye for now. Bye-bye.